The biggest myth is that sellers can sell their company themselves. I'm a trained lawyer like you, and we have a saying in the law that it's only a foolish lawyer that would represent himself in court. It's the exact same when it comes to selling a company, and the psychology makes sense, right? These business owners build a great business often by wearing a lot of different hats, and they have success doing that. But at the end of the day, I have seen so many horror stories of business owners who thought that they could sell the company themselves and take their eye off the ball. They get strung along by buyers. They're not running a competitive sales process, so the buyers may have no incentive to really put their best foot forward. Things drag out, the business suffers, and then the deal doesn't close. And whether it's us or a lot of the competent and professional groups like us, I would tell anybody thinking of selling their business to hire the right investment banker.
Hey everyone, this is Devin Miller here with another episode of The Inventive Expert. I'm your host, Devin Miller, the serial entrepreneur that's grown several startups into 7- and 8-figure businesses, as well as the founder and CEO of Miller IP Law, where he helps startups and small businesses with their patents and trademarks. If you ever need help with yours, just go to strategymeeting.com, grab some time with us to chat. We're always here to help. Now, today we've got another great guest on the podcast, Brett Story. And Brett, we're going to be talking about a few things, including how to sell a company, also about mergers and acquisitions and having a sales plan and having objectives, and also a bit more on the regulatory side as far as a business and what licensing services you might want to think about. And we even may touch a little bit about what to know with the investment banking. So it should be some great areas of conversation, and definitely looking forward to it. So with that much as an introduction, welcome on the podcast, Brett.
Thanks, Devin. Great to join you again. Excited to have this discussion. As you mentioned, we specialize in helping business owners who are looking to sell their companies and navigate the process of selling for the best possible financial and non-financial terms. So excited to share a little bit about what we've learned with your guests.
Awesome. Well, definitely excited to have you on, and looking forward to a great conversation. So just as a quick reminder to the audience, Brett was on our sister podcast, The Inventive Journey. So for those that haven't had a chance to check out Brett's full journey, definitely encourage you to go do so there. But now as we kind of dive into a bit more of the area of expertise, I mean, I think that I wouldn't recommend people going into a business with the idea if you're going to sell it. Not in the sense that you don't want to sell it and make money, but in the sense that if you go in with the objective of selling it within a year or two, you're usually not going to set it up to hit and maybe I'm completely wrong and you can correct me, but you're usually not going to hit the metrics of, hey, we're going to set it up that we have a good customer base, that we have a good brand, we have a good reputation, that we have the technology in place or whatever that might be, because you're so focused on we're just going to try and hit the metrics that are needed to sell it. But I could be completely wrong, and maybe you'll go through and say you should think about that from day one. But I'm interested to hear, kind of if you're to walk through, if you're to look and see how to go about setting your business up to sell it, or to what you should consider and kind of what those objectives are and what that plan might look like. Kind of catch us up or walk us through that a bit.
Yeah, you're not wrong. It's not flipping houses, right? And so every entrepreneur at some point begins to think about what comes next. What is the transition plan for the company after you're established and you've built a great business? Am I going to turn it over to my kids? Am I going to turn it over to the employees, or am I going to sell it to a third party? But when you're starting out, there are common themes that every great business exhibits, and that's a relentless pursuit of what you're really good at, and figuring out what your niche is, what service or product that you provide that the market needs, and then doing that exceptionally well. It's hiring the right people and building a infrastructure in terms of leadership that is duplicatable and can provide for contingencies. It's making sure that you're ticking all the boxes with someone like yourself, Devin, on the company's intellectual property, its corporate governance documents, all the legal and tax work that is a necessary but very important part of a sustainable business. And then it's obviously finding your customers and treating them right and well so that they continue to come back. But what we usually see is it's different for every business, but once a company is established and growing, usually past the 5 or 10 year mark in many cases, then those owners start to begin to think about a succession. And that could just mean, selling a majority, but remaining involved in the business, or maybe it's a bigger plan to sell the business and walk away at some point in the future. But it's exceedingly rare to see a company where the business owner started it just with the express intent of selling it in 2 to 3 years. That's very difficult to pull off.
So now, if you were to say, okay, and I'll do this as a self-interested or question maybe, but one of the things that there's a difference, at least in my mind, and again, if I'm saying things that are incorrect, correct me. But a little bit of when you look at a service-based business versus a products-based business, as far as how you might set it up for selling it, or the considerations, in the sense that products-based business is, I would say, in quotes, easier to sell, and probably not necessarily easier, but different in the sense that what you're established with a customer, what you're established with your customer base, and kind of what you're selling to the acquirer is maybe a brand that's going to be tied to a product, or the business, and the customer base maybe have intellectual property. When you get into service-based businesses, a lot of times it's much more reputational based. So it's, hey, people like Devin, just as an example, or I have a good relationship with them, or I talk with them. And so now if I step back and they transition it over to someone else, it's a different relationship. So maybe walk us through are there any considerations for what you should be looking at, differences between a product-based business or a service-based business?
Yeah, I agree with the analogy. What I would say is I'm not sure that one versus the other is any easier to sell, but in a service business, the people are the product. And so, when you're establishing a service business, and it can be really any sort of B2B service, the people that you hire, the ones that are winning new business, the ones that are servicing clients, they're really the product at the end of the day. And so the consideration when you're going to sell a service business is, how do I keep that continuity? Who is the leadership? How do I retain great people and keep them incentivized in growing the business? How do I reward them financially for the blood, sweat, and tears? Versus a product business where there's challenges around supply chain, there's challenges around where are you manufacturing the product, and margins associated with running your own manufacturing versus outsourcing that. But you're right, it's much the people are probably less important in a product-based business than they are a service-based one.
So let me follow up with that, and maybe shifting here slightly, but I think it follows up with the conversation, which is, when people hear different things. One is mergers and acquisitions. Another one is just selling the business outright. Now, maybe they're the exact same thing, or are there any differences? Or kind of walk us through when you're thinking about, okay, I'm in the business for a little while. Should I look at selling it? Is it a merger? Is it an acquisition? What, kind of walk us through what are those differences, and kind of how do you approach them?
Yeah, so the term M&A, or mergers and acquisitions, is just a broad category of a vernacular representing a business transaction. Most often what we're talking about is the acquisition in mergers and acquisition. And that's simply where a business is purchased, either assets or stock, by a third party. That is most often what you see when you're talking about M&A in what we call the lower middle market. So that's companies from, call it 1 million to 100 million of revenue. From time to time, you may see a merger, and a merger tends to mean a stock swap where a bigger company and a little company will combine, and there's not much cash that changes hands at the transaction, but instead they kind of each exchange equity to form a larger business. But that's less common. So mergers and acquisitions, or M&A broadly, refers to the sale of a controlling interest in a business.
Hmm. So now, how do are there I'm sure there are merits. Walk us through, maybe that's a better way to say it. Walk us through the merits of, selling it out. And I could guess that, and I'm sure a lot of people could, but merits of selling it outright or a majority ownership, such that you're more passive versus maybe a merger where you stay more involved, or is that a reasonable? Is it typically that you merge and you remove yourself from the picture because they already have management, or you transition, or kind of what are those different options?
Yeah, the way I like to frame it is it's all down to what the seller is trying to achieve. And so if for the vast majorities of sellers that we work with, I'd say 8 out of 10, they're younger founders of a business, in the 35 to 55-year-old age range. They've built a great business, but that business is a significant, if not most, of their net worth. And at some point, you reach the decision that, hey, maybe it makes some sense to take some chips off the table, to sell a controlling interest in my business, take some cash, provide for my family, set that up as a safety net so that you've taken some of the risk out of having this private business as your whole net worth. And so that's most often the transaction that we execute. Now, in almost every one of those cases, the seller is sticking around. So he or she has said, you know what, I want to sell 70% of my business, for example. I've found a financial or a strategic buyer that I believe can help me get to the next level. And because I'm so bullish on my company, I'm going to retain 10 or 20 or 30% equity and get a second bite at the apple down the road. So we've been a part of a lot of transactions where a seller has sold, say, 60 or 70%, kept some equity, and then 4 or 5 years down the road, sold again and got sort of a second cash out. So that's specifically addresses the seller's need for wanting to de-risk and take some chips off the table. Now, there may be other instances where that's not important to the seller, but what is needed is, in order to compete and grow in a certain market, I really need to merge with a larger organization who's got more purchasing power or got bigger and better infrastructure or has deeper pockets for sales and marketing. And, because otherwise I may get swallowed up. And so sometimes that analysis is more about survival and capturing the market than necessarily the seller wanting to take chips off the table. So point being, every seller that comes to us has a different set of objectives. And our goal is to first understand those objectives and make sure that the seller's vision is clear for what they want to do, and then go out and execute that deal.
No, it makes perfect sense. So now, kind of as you do that, now you started to touch on and maybe expand on a little bit, having a sales plan and having those objectives. How do you go about putting that together, and what does that look like, or what are at least? And I'm sure it's varies depending on different businesses and kind of what your plan is. Maybe what are the considerations or the things that you should start to look at as you're contemplating pursuing something?
Yeah, it starts with a lot of listening. So, typically when we meet a prospect, whether they want to, they're thinking about selling now, or maybe they're thinking about selling a year from now, it's, what is your why? What is the reason that you think you want to sell, and why now? What sort of timing is driving you to the decision? And we'll often discover it can be personal. Perhaps it's financial, perhaps it's as I referenced before, wanting to de-risk and take chips off the table. But we just listen, and you usually discover pretty well someone's motivation when you listen to them talk about the business and why they're thinking about selling. A lot of times it's bringing on a majority partner that can help execute a certain strategy with a new product, or maybe in a new geography. So we listen, but the things to think about are, what do you want your life to look at like after the transaction? Because buyers run the range between sort of passive buyers who will maybe check in with you once a quarter at a board meeting, and who really only will get involved if something goes badly, to more active buyers who are involved day to day and maybe that's what the seller wants, but sellers need to understand that, for the first time in many years, they're going to have a boss in some respect after they sell a majority of their business. And so what do you want, what do you want that to look like, that work dynamic? And a lot of sellers come to us because there's certain things they're doing day to day that they would rather not, and they'd rather focus on what they really do well. Maybe it's business development, maybe it's product design and development, but obviously financials and valuation is the first hurdle, because if you're going to sell a majority of business, you're going to want to know that you're putting enough in your pocket after taxes and fees for it to be worth it. But after that, there's a lot of non-financial concerns. What's going to happen to my employees? What is my life going to look like? Maybe in some cases, how long am I expected to stick around before I can potentially transition out of the business and go do something different in life? So, we spend a lot of time on the front end really getting to know these sellers and what makes them tick, and what's going to cause the transaction to be successful in their minds. And then, we reverse engineer that and go find the right partner.
No, makes perfect sense. Now, I was gonna go on to the regulatory stuff as well, but one thing that you hit on that comes up a lot, especially with a lot of I think a lot of the audience, the ones that I work with, is on that business evaluation. A lot of times you're looking at that a business evaluation and saying, one, how do I even go about doing that? In other words, if there's a big business and maybe there's a recent sale, you have a bit of a comparable. On the other hand, a lot of times you don't know, how do I evaluate? I can look at profit or reoccurring sales, and maybe that's a part of it, but how do you go about evaluating? Are there people out there that offer that as a service, or do you have to do it yourself? Or kind of, how do you figure out what the business is reasonably worth as you're then planning to make that merger or acquisition or sale?
Yeah, it depends on the reason for having the valuation done. There are plenty of great firms who will do a business valuation for a fee, and that typically is most often utilized for tax or estate planning purposes. For example, if you're granting your employees options, you need to have a valuation done for purposes of the employees understanding what those options are worth for their own tax reasons. Similarly, for estate planning. So there are firms that specialize in those types of valuations, and that's often based upon sort of a hybrid analysis of the private markets and public comparables. The difficulty there is that in the private markets, we almost never announce the transaction valuation, let alone the formula at how we arrived at the valuation. So if you're wanting to know what your company is worth in terms of a sale, you really should go to a sophisticated investment banking or mergers and acquisitions advisory firm who has executed deals routinely, and ask them for their perspective on a valuation range. And that's something we do pro bono, because frankly, it's a lot easier for us to call up the buyers that we know well and brainstorm with them around the valuation for a certain kind of business. And it's not necessarily essential for us to draft a huge 20-page valuation report, because that's not really what the seller needs in that specific situation. And you'll find that there is, not surprisingly, often a gap between what a 409A or a tax valuation will say and what actually somebody will write a check to buy, because the information is not readily available as it is in the public markets, when that T-Mobile and Verizon and Sprint are all trading within these certain metrics, and it's pretty easy to compare them all. That's not the case in the private markets.
So makes good sense, and definitely gives some guidance and guidelines for what people might want to consider as they're looking into that. So now, as we are shifting, I would like to hit on, because one of the other things that not all business, I would say, I don't know, not all businesses, but businesses are of varying levels or varying degrees, we'll hit into regulatory, different regulatory requirements for the business. And, that can be everything from if you're an FDA business or your medical related product, you may have to deal with the FDA. If you're a service-based business, like you're a foods-based business, like a restaurant or a food truck, then you get to deal with, some of the local governments. If you're having to have a license, like an attorney, then you get to deal with the licensing. And so, as you're looking at kind of a regulatory, and I know even more specifically within the service-based business, what are some considerations, or how do you go about tackling figuring out what regulations or regulatory things you have to do for your business?
Yeah, again, that's it's all down to hiring the right advisor and somebody who's experienced at reviewing a company and understanding all of the opportunities and hurdles to getting a sale accomplished. And so what we will do is on the front end, before we ever go to market, really get our heads around what the regulatory regime is, and specifically what kind of approvals will be needed if there's a majority sale of the business. And I can point to an industry where we've had a lot of success over the last 5 years, which is title insurance. So we've sold a number of title insurance agencies, probably been one of the most active investment banks in the country in that industry. And every state has their own requirements for what it takes to be licensed as a title insurance agent. And so when we've executed those sales, there's often been approvals needed at the state level. And you really need a competent advisor to keep people on schedule there, because one of the things that can happen is the parties can come together, they can agree on the asset purchase or stock purchase agreement, they can really have everything involved in the deal buttoned up, but then find out that the state of Colorado, for example, is not going to approve the sale without a lot more information, or maybe they've got a backlog, as so many states do across the board now, and they're not going to approve the sale for 6 months. And so that can really frustrate buyers and sellers if they're left to be surprised at the regulatory approval side. So it's just something that you need to get out in front of and understand very early in the sale process.
No, that makes perfect sense. And one of the things that you hit on, I think, is an ongoing takeaway is getting those right advisors in there early on. And I think that sometimes even when you're looking at intellectual property as an example, everybody's hesitant to, hey, well, I don't want to necessarily get the advisor early on because it's going to be expensive. And what I typically will tell them is, you may get in there and the advisor may tell you, hey, here are the things you consider, what you'll want to do, and the plan and the approach that you want to take. And it's too early on for us right now, but here's when you want to reach back out and engage us. Or, hey, you're already past the ball and you're going to get yourself in trouble with governmental agencies if you don't do something really quick or get that remedied. So I'm of the of the opinion that pushing it off and never having those conversations with the right experts is almost never the right thing. And even if you can't afford them now, go out, do a free consult, talk to them, pay them 15, 30 minutes and get an idea as to what you need for your business.
100%, Devin. And IP is a big one, as is tax, and making sure that you're handling the tax regime in the right way. I mean, we had another deal involving a telecom services business, and the company and its data center was based in Arizona, but it was selling VoIP and telecom services to small and medium businesses in every state in the country. And there was a legitimate sort of gray area as to how that was supposed to be treated from a tax standpoint. And ignorance is not bliss when it comes to these M&A deals, because nobody's going to write you a 7, 8, 9-figure check without understanding every little piece of the company, including how you're treating IP. Have you got your trademarks? Have you got your patents? Is your software even copyrightable, or tax, or whatever it is? So it's, get ahead of it early, because drama kills deals. And the worst thing that can happen is you be, in the LOI or getting close to closing a deal and a surprise comes up, because that really has a disproportionately negative impact on the deal. Trust can go out the window, buyers can get cold feet, and then you've wasted a lot of time and money and not closed your deal.
No, I couldn't agree more. And it's, there's so many times that you think you'll have the deal all buttoned up and closed, and then you'll get the, hey, what about this? Or you didn't tell us about this, or the what ifs. And more
Yeah.
often than not, and tends to be, at least in my experience, a lot of times a deal killer because it makes people nervous that they weren't aware of that on the front end, and that you didn't raise that, and especially if you weren't aware of it, then they're saying, what else do we not know? So I think that's definitely a great piece of advice, and some great takeaway. Well, we're already reaching towards the end of the episode, and it feels like we just got started diving in. And so we'll have to have you back on to one of our sister podcasts and continue on the discussion. But at least for today, as we kind of wrap things up, I always like to wrap up each episode with the same question. So jump to that now, which is, within your industry, what is the biggest myth and why is it wrong?
The biggest myth is that sellers can sell their company themselves. I'm a trained lawyer like you, and we have a saying in the law that it's only a foolish lawyer that would represent himself in court. It's the exact same when it comes to selling a company, and the psychology makes sense, right? These business owners build a great business often by wearing a lot of different hats, and they have success doing that. But at the end of the day, I have seen so many horror stories of business owners who thought that they could sell the company themselves and take their eye off the ball. They get strung along by buyers. They're not running a competitive sales process, so the buyers may have no incentive to really put their best foot forward. Things drag out, the business suffers, and then the deal doesn't close. And whether it's us or a lot of the competent and professional groups like us, I would tell anybody thinking of selling their business to hire the right investment banker, because the fees that we make, we pay for tenfold in ensuring the deal gets closed for the best terms, and letting you keep focused on running the company.
No, I think that's definitely a great myth to dispel, but also a great takeaway as well. So, well, now as we do wrap up the episode, if people want to reach out to you, they want to be a customer, they want to be a client, they want to be an employee, they want to be an investor, they want to be your next best friend, any or all of the above, what's the best way to reach out to you, contact you, find out more?
Yeah, my email is brett@brighthorn.com. I'm always happy to talk with business owners and, again, give perspective on valuation for no charge. And I can also be found under Brett's Story on LinkedIn. Always love connecting with people there as well.
Awesome. Well, I definitely encourage people to reach out, support a great business, make a new connection. If nothing else, make a new best friend. So with that, Brett, thank you again for coming on the podcast. It's been fun. It's been a pleasure. Now, for all of you other listeners who are out there, if you have your own journey to share and you'd like to be a guest on the podcast, we'd love to have you. So just go to inventiveguest.com, apply to be on the show. A couple more things as listeners. Make sure to click share, subscribe, leave us a review. Helps us to reach even more startups and small businesses to help them along their journey to success. And on that note, if along your journey you ever need help with patents or trademarks or anything else with your startup or your small business, just go to strategymeeting.com, grab some time with us to chat, and we're always here to help. Well, thank you again, Brett, for coming on the podcast, and wish the next leg of your journey even better than the last.
Thanks, Devin. It was great.